Hey everyone, how's it going? This is Richard and welcome back to the Traderline channel. And in this tutorial, we'll be talking about one of the best moving averages that you can use as a trader, and that is the 10-week moving average. And we'll be diving deep into how you can use this to get the most out of it and to improve your trading performance. So stick around. And if you do find this helpful, go ahead and leave a like down below. And of course, subscribe if you haven't yet and want to see more videos just like this one in the future. With that said, let's dive right in to what we'll cover in this video. All right, so here's the outline for today's video. First, we're going to take a little bit of a step back and discuss why we're looking at weekly charts in the first place. I promise you, whatever your time frame, looking at weekly charts will help your process and really give you clarity about where the market is going. So that's really important. Then we'll move on to studying the greatest stocks of all time, looking at the research that William O'Neill did into why he's using the 10-week moving average and how you can use it as an add point or as a trend indicator. Then we'll discuss those two uses a little bit more in depth, and then talk about basically how to use the 10-week moving average both during uptrends and downtrends, and then we'll do a quick recap at the end. So that's the game plan, and let's dive right in. All right, so let's start with why we're looking at weekly charts in the first place. Well, we basically want to take a step back and zoom out and eliminate the noise that exists on those daily charts, and especially on intraday timeframes. You know, there can be a lot of erratic moves up and down intraday and even during the week that at the very end of the week, nothing really happened, but it was just kind of some short-term algos or short-term news impacting things. And basically the weekly charts allow us to kind of focus on that true trend, that longer-term trend that is guided by institutions. And we want to basically align our actions, whether we're a swing trader, position trader, or especially an investor, with that longer term true trend. And weekly charts help us focus on what really matters, which is that longer term price movement. And to the next point, weekly charts basically help us decrease our actions and really focus on moves that matter, true breakouts that actually stick throughout the end of the week. So if you're looking on an intraday time frame, there can be so many setups, even intraday. And even on a daily chart, there can be a lot of false moves, during the week that don't stick. So looking at that weekly chart helps us decrease our activity and really focus our actions on what truly matters. And by default, if we're looking at a weekly chart, there's going to be less buy signals and also less sell signals, so less for you to worry about. Finally, as I mentioned before, we want to focus on that true trend. And just looking at this chart of Roku, you can see this nice move in 2020 above a rising 10-week moving average. That's this blue line here. And then we have one last base. It fails that breakout, and then we see it undercut this moving average. That starts to slope down, and we basically ride this moving average downwards, and you can see it's basically resistance at multiple points. And we'll get into a few more examples later on in the video. But basically, this true trend is defined by that 10-week moving average. If we're above a rising 10-week moving average, we're in an uptrend. If we're kind of chopping around it and forming a base, that's just kind of a sideways consolidation phase. And then if we're below a declining 10-week moving average, that's when we want to either have exited prior or be short the stock because we're in a longer term downtrend. So that's very quickly how we can use the 10-week moving average to improve our timing and align our actions with that of the market. So that is why we use weekly charts. Basically zoom out, eliminate the noise, and focus on that true trend. Okay, so now let's talk about the next subject, which is kind of going back and studying history and basically analyzing why the 10-week moving average works as well as it does. So this research was really done by William O'Neill, who is a fantastic trader, as many of you guys know, and also the founder of IBD, Investors Business Daily. And he basically went back and studied, going back to the 1900s, what were the greatest stocks of all time and what characteristics did they share, both in terms of their fundamentals as well as their technical characteristics during their moves. And the 10-week moving average is one of the key moving averages that he plots on his charts. And here you've got an example with Texas Instruments, TXN here. I'm not sure what year this is. I cut that off at the bottom to make space and really focus on the chart. But this is one of the greatest performing stocks of all time. Looks like we moved up from around 20 all the way to 260 in just a matter of months. And most of that was above a rising 10-week moving average, especially as it's trending from base to base. So looking at the key points here, during this move, the 10-week moving average is a common area of support in its uptrend. If you see right here, this red line is often support during this move. It consolidates, undercuts a little bit during this base, but then once again, it's pulling back into the moving average as it goes from base to base. And as it gets kind of later on its move, you can see it undercuts a little bit more. And that's something to look out for. And that's a sign potentially that the trend is nearing its conclusion. Then another key point is that you want to focus on the first 2 to 3 touches of this moving average. You can see here, it's labeled here from O'Neill himself. You can add to the position the first 2 to 3 times a stock pulls back to the 10-week moving average line. And this pullback is basically caused because after that first pullback, there are going to be some natural sellers who are not looking to hold for this entire move. And then kind of that natural selling, or even that lack of, significant accumulation where people really stepped on the gas here, they're less aggressive later on in the move. That kind of leads to this subtle pullback. And you basically want to see a drift down into the moving average on lighter volume versus, a sharp decline in just 1 week or two. You basically want to see a drift downwards into that moving average and then have it rebound strongly on volume. And that is often an excellent buy point the first 2 to 3 times that it touches that moving average. And even if you miss that initial breakout, that can be a nice entry point for a swing trade. Or if you bought on the first breakout or earlier in the base, that can be basically a point to add to your position after that first natural pullback. So that's basically 2 of the key points here. And then lastly, there may be undercuts during bases. That's definitely something you have to be aware of. Ideally, you've got your cost basis to a point where it's down here. So once it finally undercuts that 10-week moving average or the 50-day moving average on a daily, you're kind of sitting pretty and you're willing to give it back a little bit of your profits because you know that it's completely natural for a stock to base, and you want to see it kind of retake that 10-week moving average. And that, once again, can be another point to add back to your position if you sold into strength. So that's a little bit about studying history. I would highly recommend going through this document and just looking at this chart a little bit more in detail because these notes from O'Neill are gold. And he highlights multiple times how he uses the 10-week moving average. As you can see, the end here, it's a sell because the stock tries to rally above the 10-week line and then reverses on volume 219% above average. So really focus on this red line, this moving average, as you're looking at historical charts of winners. Okay, so going back to the key point, what are the main uses for moving averages in general? Basically, there's 2 main uses: trend analysis, determining whether we're in an uptrend, downtrend, or just chopping, and then also position management, actually doing buys or sells based on signals using those moving averages. Speaking to the first point, using the 10-week moving average, as I mentioned before, we're technically in an uptrend. If we're above a rising 10-week moving average, that's often a great time to be involved in a growth stock. And then when that kind of flips and we're undercutting the moving average on high volume and we're trending below a declining 10-week moving average, that's when we want to be pretty much out of the stock or even short, depending on the situation. And that is basically technically a downtrend. And to speak to the second point with regards to position management, basically we can use a moving average like the 10-week as a spot to either add to our position, as I mentioned on the previous slide, or even you can use it as your trailing stop. So you set your stop at the 10-week moving average each week. And if the stock undercuts that, that's a sign that potentially the trend is over and you are basically naturally taken out of the stock. I usually wait for 2 closes below a key EMA on the daily chart. You can do a similar thing on a weekly basis if you're a longer term investor or position trader. But basically you can write a whole bunch of rules with regards to position management, and it's basically a great trend following indicator. So that's basically the 2 main uses for moving averages. Moving on, let's talk a little bit more about the 10-week moving average during uptrends. And here we've got an example of NVIDIA back in 2016. Here I've got the 10-week moving average plotted in blue. So for the most part, the stock should trend above, especially going base to base. You can see we're basing here below these highs, and we do undercut it and kind of chop above and below. That's natural, especially after a strong move from 8 to around 26. But for the most part, when we're trending, this should be a spot of support as it was here, here, and even here. So that's basically the key characteristic that you want to look for with regards to the 10-week MA. As I mentioned, undercuts may occur during the bases. This is a potential area of support. But one more way that you can use a 10-week moving average is you can kind of look at the past and look to the left on the chart and see how often or how far the stock usually gets above that 10-week moving average. So basically, as an example, if you look to the left on the chart of NVIDIA and see that it often gets about 20% above the 10-week moving average, then going forward, you can kind of use that number as a guideline. And, here we spike well above that 20% level here as well after an initial move up. And those are points where the stock will often, at the very least, pull back, consolidate, and maybe even start a full basing process. And so those points are often great points to sell into strength a little bit, maybe a quarter of your position, a third. So you can kind of sit through a little bit more easily those basing and consolidation periods. So once again, a big spike here. We're extended from this moving average. It has to pull back and it pulls all the way back to the moving average. So you can sell a little bit up here. Once it kind of hits that 20% threshold, obviously you're never going to sell right at the top, but you can kind of, work around with it. And then you can add back those shares as we confirm off the moving average or after a nice pullback. So that's one more way that you can use the 10-week moving average during uptrends. During downtrends, it's very similar. For the most part, the stock should trend below this moving average here. We've got Twilio in 2022. A lot of growth stocks look exactly like this chart right here. And there may be some overshoots here above it, but for the most part, this should be a spot of potential resistance. And the stock has been rejected multiple times from this key moving averages. This key moving average, as you can see, going back in its history after it initially failed its move up. Here we've got a consolidation phase. This transitions to a downtrend, and that's where we see all these rejections. So it's kind of a mirror image of an uptrend. Here we're below a declining 10-week moving average. All right, so that's pretty much it with regards to the 10-week moving average and how to get the most out of this indicator. Here are a few key points that I want you to take away from this video. First, weekly charts and the 10-week SMA can help you eliminate noise and show the true trend of the stock. Second, it is effective both during uptrends and downtrends, as we saw in the examples. And lastly, it can be used as an add point after the breakout on those first two pullbacks to this SMA. And as we mentioned previously, you can also use it to sell into strength if we do get extended historically from this moving average. So that's pretty much it for this video. I hope you guys enjoyed. Let me know your thoughts down below. Do use the 10-week moving average. Use an equivalent moving average on a daily chart. Let me know. And also, if you have any suggestions for videos you'd like to see in the future, let me know down below. And if you did enjoy this video, go ahead and leave a like and subscribe. And I'll see you guys in future videos. Take care.